as much as founders might not want to hear it.
Plain and simple.
Let's bet the house.
How difficult it is to raise a venture capital fund.
If your investors are telling you,
what do you consider relevant for a founder to be the leader of a company?
Let's wrap it up without shutting it down.
Barbod Namini, welcome
That's
back.
me. I'm back.
How's it going?
Yeah, very good. Thanks for having me back after the good fun we had the last time.
Yes, it's our honor, and you're the first guest that is repeating.
There you
So
go.
that's because actually the show went super well. We received many good comments and many good feedback. So thanks for coming back. It's an
Or
honor.
you ran out of guests in Munich.
I'm just again taking the loop.
Exactly.
Well, actually, the idea for the long run is to do this. Like, first do this interview that is more general. By the way, everyone, you can check the first interview with Barbod, where he explains who he is and what he does, basically. And then going a bit deeper in topics. That's a little bit also the idea.
Yeah.
So, yeah. And this is a completely new format that we're just testing because you were so kind to let us test it.
Let's see, yeah.
So let's see how it happens.
The Q&A format.
Yes. I had some questions. I can tell you already some names. Of course, I didn't pick all the questions. I just picked some, but we have Guillermo from Mohab, Alberto from the Pacify, Hannes from Big Little Things, people from Wayra, of course, Usman from Apex E3, KPN, B Square, Extension Fund, Mitigan, like companies, funds that they were dropping all random questions.
Nice.
And I just did a selection of the questions that I think are more relevant that could...
The spiciest ones.
The spiciest ones. And I think that they're pretty interesting, almost most of them. But before that, I want to congratulate you for becoming my general partner. Last time you were here, you were a little bit below. You're a partner. Now you're a general partner. I think that's because of the effect of Wiz, of What's in Store Show. That's obvious, no? But the first question is, what has changed for you now that you're a general partner?
Well, a lot and nothing at the same time. So obviously the core of the job remains the same. Lead an investment team, deploy the fund well for our LPs, and continue the legacy of what HV is. But at the same time, a lot changes into the role because as founders also know, obviously running a company, the investment part of the VC is the shiniest part, but you still have to run the company. And any CEO in any startup knows how much admin there is on the back end. The general partner effectively puts you in the spot of being part of the managing sort of group of the company, meaning that all at once company management becomes part of your role as well. And that's obviously very time consuming, but very exciting at the same time because you get to shape the future of the fund as is. Obviously there is fundraising associated to it, but really the core of the job remains that of leading an investment team. Okay, so what I get from your answer is I get more job, but basically it's pretty similar, but I get more job. Well, it's sure there is more work to do, but it's not something I'm complaining about. I very much wanted to be in that position. And if you like what you're doing, more work is not necessarily a bad thing, especially if you feel that the work you're doing shapes also the future of the company. So by all means, I'm very happy to have more work to do. That's insane. So congratulations again for that. Let's gonna dive in a little bit, little by little, in the questions. Because this format is a bit peculiar, maybe we do it shorter. Yeah. And maybe we release 2 episodes. Maybe we would release 1. Let's see how it goes. So the first question is actually, I think, related to this new role. That is how difficult it is to raise a venture capital fund. Plain and simple. Right. Yeah, probably. I mean, we are long-standing fund, so I wasn't part of the first raise that started it all. So maybe let me divide my answer into 2 parts. Generalizing, then what is the commons or knowledge of raising VC funds, and then distinguishing it between normal times and recession years. Because it's quite interesting. The last couple of years, obviously, were not normal times per se, in the same way that 2 years before that weren't normal. So I would say the common saying is the first and the third fund are the most difficult to raise. Yep. Why is that? Let's put exceptions aside. Obviously, if you are a serial founder that had $1 billion exit, put 100 million of your own money, and you're raising a 150 million fund, well, things are going to be easy, right? But let's take your sort of normal setup, successful sort of individuals that had a good career in finance, operationally, consulting, whatever that might be, that put together enough money to be able to even contemplate in starting a fund, because let's not forget, you need quite a bit of startup capital as well, because you're committing your own money, you have to set up things, etc. As a first-time founder, obviously, you are pitching LPs, and again, I'll talk more about institutional funds. If you raise from sort of friends and family, it's a different concept. But in institutional funds, in the same way that the founder pitches VCs and VCs see thousands of companies, LPs, it's not that difficult of a situation. You are there trying to convince them to back you as a person, and you'll make the reasons why you think you might have a different into the market, why some type of founders might let you into the best portfolio companies, but really you're convincing the LPs to back you. You won't have a track record institutionally, but you might have a track record as an angel investor, which obviously helps. And if you do have a track record as an angel investor, then also having founders vouch for you helps. However, difficult the difficult thing to do. You pitch all your LPs. Let's say you raise your first fund. Now, why is the first and the third and not the first and the second? More often than not, fundraisers work on a give or take 3-year cycle. So you're going to raise your second fund after 3 years. After 3 years, it's still too early to say whether you have had a good track record, where you have done good investments, because let's face it, if you have been investing for 3 years, a lot of companies are very new. You were the first round. There haven't been any follow-on rounds yet. So when LPs back you for a fund, mentally, very often they back you for 2 funds. Why is
Makes
that?
sense.
Because obviously, if they back you as a person and they believe you are a good chaperone of capital, you're a good asset allocator, then it's in their interest to keep you running. Fast forward to fund 3 or 6 years into the fund, well, the investments of the first fund start crystallizing. So the LPs all at once have a data set upon which they can evaluate whether you're a good fund manager or not. So fund 3 can be that life or death experience where you might not raise fund 3 and then that was that, or you get through that hump and all at once you're a multi-generational fund. And then things, they never get easy, because ultimately you're always going to be measured against your performance. But then you have a long-standing relationship. You have LPs that have invested for 3, 4, 5 funds with you. You have developed that personal rapport, etc. So it becomes a bit different beyond that. Now, let me close that parenthesis and talk about recession years. And all that I said kind of wasn't really applicable maybe in the last 2 years, and it's not really applicable in recession years. Why is that? Because there is a technicality that maybe the outside world doesn't see as much, and that is that institutional investors, LPs into venture capital funds, obviously are very large funds that deploy their assets in a diversified manner across asset classes. And they have some restrictions on what percentage of the asset can go in any asset class. In recession years, what you have very often is that the public markets come down. However, the private equity asset class, including VC, given that it's not mark to market, stays somewhat stuck at the last valuation they had. Meaning that all at once, artificially, the percentage allocation in private equity raises due to the fact that the public markets are coming down. And all at once, that puts a lot of LPs in a position where they are not allowed to invest in venture capital anymore or in private equity because
risk management.
Risk management, they are above the maximum threshold, not because they overinvested, but because another part of the portfolio came down. And what do they do in those years? They'll find exceptions for managers that have a very long-standing relationship for them. So obviously, if you have invested in 5, 6, 8 funds of a certain manager, you won't drop that manager. You don't want to lose the relationship. So you will find the exception on how to allocate. But those are not the years where you take a risk on a first-time manager, or maybe even fund 2 in funds where the relationship is not as strong, where the track record is not there yet, etc. So those are years where it's incredibly difficult to raise as a fresh GP, fresh manager.
I can imagine.
We just finished a phase like that, and hopefully the market is normalizing. Public markets have come up, so that readjusted obviously some of those technicalities that were stopping LPs from investing.
They came even way too high. We'll see. I don't have any macroeconomic question, but maybe I'll leave one for the end. Next one is, what are some guidelines that you could provide to get or guess even the right valuation for a company in a regulated fintech space, which is that it's special.
Yeah, difficult question. I think on the early side of things, valuations are more an art than a science, because you're not really basing your analysis on too much data. There might be a year of data, there might be no revenues yet, even 2-3 years, it might not yet be statistically significant as such. So sure, you have the public market somewhere as a guideline, but it doesn't matter as much because you're still very early and you still have a 10x, 100x, 1000x to grow from there. So I would say one point to be made about regulated businesses that makes it a bit more difficult to derive the valuation is if you need regulatory capital. Now, if you're getting regulated, and this might be mainly relevant for fintech and insurtech, and there is a regulatory capital component to what you're doing, you have to be prepared to the fact that early investors are a bit allergic to idle capital. So obviously they don't want to put their capital in a bank account untouched. The whole point of high risk capital, early stage capital, is that that capital allows you to grow exponentially, and not that capital stays idle on a central bank's bank account. And that puts you in a position where it cannot be debt because it has to be equity. It puts in a position as a founder where if you don't navigate that complexity well, you end up diluting a lot, because then you have to raise from pockets of money that say, well, that capital will make you grow, and currently you're not making much revenues, so the valuation should be very, very low. And to avoid that, you have to be able to pitch why getting the license effectively is the catalyst to hyper growth in whichever business you are. Hence, make the investor buy into the vision that while that capital is idle, it's actually the catalyst to growth. And get a valuation that makes sense for you as a founder as well. And obviously, if we want to stay on the very simplistic level, 15 to 20% dilution per round is more or less the accepted ballpark. And then what are the rounds where a seed can be 3 to 5 million, and A can be sort of 8 to 15 million, a B 20 to 50 or more. So then you reverse engineer to what that means in a valuation perspective. But yeah, there is no right answer for all regulated companies.
But this reverse engineer is very interesting, because sometimes what I found, and I think that this question comes from the fact that they're facing some like, okay, you're doing 25K, or
Yeah.
I'm gonna put it super extreme, 25 ARR, 25K. So like I multiply that to 10.
Yeah.
I mean, say your company is 250K valuation pre-money. And what you're saying is do the reverse engineer to what do you need or where do you need to be, and the storytelling, be super good with the storytelling. Don't.
Yeah, ultimately, I mean, if your investors are telling you 10 times 25K, then you either are not speaking to the right investors, or you didn't manage to package your company as a VC case. Because
Totally.
let's face it, VC investors willing to pay the future only do it if they have a feeling that you as a team and the product you're building can become an outlier success story. Now, not every company has to be a VC type of company. Not every company will be a multi-billion-dollar company. It's perfectly fine to build a company that caps at 5 million in revenues but does 1.5 million in profits. And let's face it, if you bootstrap it, happy days, and you might be a very, very successful individual with your 1.5 million profits a year. And it's totally fine. And you shouldn't be pitching VCs, and you shouldn't be a VC company, and maybe you'll have a wonderful life and you are more successful than most people on earth, obviously.
Yeah.
So it's important to put things into perspective and see what you really want to achieve, and then speak to the right investor if you need an investor, and know what the path you chose means in terms of what you can get in terms of valuations.
Yeah. And I don't want to derail from the questions, but it's like this leads me to the topic that some companies, they call themselves startups now, and not now, today, 2024, but also 2023, 2022. And it's like, you are not a startup. You need to, if you need this risk capital to be able to grow exponentially, but you're growing based on, I don't know, I don't want to say anything that a hairstyle salon, this doesn't scale because, I mean, you can make a lot of money. It's a good case, could be a very good business, but it's not the VC case, maybe.
It's not a VC case, and that's totally totally fine. I mean, not every entrepreneur needs to go the VC route.
That's it. Yeah, I just think that the label of startup became too popular sometimes. But
maybe it gets associated more with VCs, but ultimately, hair salon is also a startup. A first-time VC fund is also a startup per se. The term startup just means that you're a new company, somebody founded it, and you're trying to find your way in the world.
Yeah.
A VC startup is obviously, yes, a company that should meet certain criteria.
Yeah, agreed. Then we have one question that it was related to Africa, but I think that what makes more sense to ask you is that why don't you invest in specific markets like emerging market regions, despite of the opportunities that are there? What's your thesis on the internationalization of the fund?
That's a question that in some shape or form, obviously I or many VCs or many investors get, hey, why aren't you investing in country XYZ? We have the most thriving sort of startup community, et cetera, et cetera. And it all might be true. Or why don't you invest in commodities, or why don't you invest in real estate? Or there are many topics. So I'll answer it from the point of view of a fund that's mainly funded by institutional capital. And this answer might be very different if you are a family office with just one person deciding, doing whatever they want. So for a second, explain why institutional funds more often than not have restrictions. You have to understand how the capital behind them works. If, let's say, part of your funding comes from a pension fund or a fund of funds, that fund is going to be exponentially bigger than your own fund. So let's say you have 100 billion pocket of money that has to invest that money. 20 million, 50 million flow into your fund. Now, given that the pool of capital is so big, that manager has to diversify.
Mm-hmm.
He or she diversifies across asset classes, so it might have public, it might be real estate, it might have VCP, etc. And within each asset class, it diversifies. So if you have that much money to manage, then the best way to go about it is not to say, I'll invest in a US manager and tell him to do the whole world, or invest in a German manager and tell him to do the whole world. He or she will most probably get much better returns if he picks the managers in the regions and says, my Africa exposure will be covered by the best GP in Africa. My European exposure will be covered by the top 3 best VCs, and so on for every country that that manager wants exposure to. Getting into HV specifically, we carve ourselves a pocket that allows us to invest internationally outside of Europe. Mm-hmm. However, we use it more for cases where there's a clear reason why we are investing. So for instance, a team that we know very well identifies an opportunity in another market and says we're going to move there and tackle that opportunity. And the reason we're investing is because we know the team and we trust them. Or a company from another market wants to expand to Europe and wants a local investor. Again, that would allow us to invest in another country, but the reason being is that we're supporting them. More often than not, going blind into a region doesn't really sort of translate into very good returns, because you just are missing too much information about who are the founders, why haven't they raised locally, et cetera, et cetera, et cetera.
That's a perfect explanation, I think. Yeah, and it makes total sense from the perspective of the LP as well. If I want to allocate my risks to African companies, probably I'll go there straight.
You go there, you find a specialist that knows the market inside out, and say, please deploy 10 million, 50 million for me into the region.
Facts. Great answer. Then there's one question related to the founders, but basically is, what do you consider relevant for a founder to be the leader of a company and to invest in that company?
Yeah, so let's first say there is a difference between early and growth. The later stage the company, the more the numbers speak for the founder.
Yeah, true.
So maybe even if the pitch is not perfect or something doesn't really sort of fall within your framework of what you're looking for, the numbers might say otherwise, and you say, okay, fine, maybe it was an off day, he didn't pitch his sales well, but I have data that shows that this founder is phenomenal in sales, or whatever the case might be. So there is that point where just KPIs and numbers become a very important part of the overall equation. But I'm on the early side of things, so we don't have too many numbers to go by. So ultimately, we have to back the people. What I'm looking for is you have to really believe that the founder believes in the vision. So you have to, no matter how crazy the vision, there has to be a passion and an ultimate belief that that is what he or she is going after, and he's not just telling a story and really just wants to be a startup founder on his CV. And there has to be a reason why that vision is important for the founder, why they are really sort of going after that. If you take an extreme case in the public world of Elon Musk, when he says, I want to colonize Mars, as silly as it sounded, and people initially say, yeah, it's just his pretty story, but he's doing something very different. He showed that, okay, he commercialized rockets, he made the company to 100 billion plus company, 300 billion plus company, and yet this is just a step towards his vision. He's not stopping it. I mean, every other person could have said, well, my initial pitch was that, but really I built a commercially viable business. Let me focus on that. So there has to be that almost obsession about what you want to do. I also very much like founders that are obsessed with products, because to me, you're only going to be able to achieve a vision if you really, really, really put passion in the product. Because if you don't, and that part starts being outsourced, and I'm not saying you have to be the developer or the CPO, but as a founder, you have to really, really care about the product. The moment you start outsourcing it and the company gets bigger, the risk is that you take people from the industry that just replicate what already exists. And your product, you pitch it in a way, but really asymptotically starts going towards what the market standard is anyway, and is not very not innovative. So once you have those two things, then there is another element that's missing. And as much as founders might not want to hear it, well, in the early years, fundraising is very important.
Obviously.
You can be the most passionate founder there is, but you still need to fund that growth, the initial stages. That doesn't mean you have to be a business major, doesn't mean you have to be a salesperson. There are hyper-technical founders that resonate very well with investors. There are very salesy founders that resonate well with investors, but you have to do it. And the sort of attitude can be, I hate fundraising, it's just money, I'm doing my thing, because then you don't connect with the investor community, then you're missing that capital to get you where you want to get.
And especially if you are a VC startup that needs capital, is one pillar.
Yeah, you need, as annoying as that part of your job is, fundraising is part of it. And
for a VC.
For a VC, it's the same. Exactly. Every 3 years, we need to fundraise because otherwise we don't have money to invest into the startup. So it's just part of the job. And either you or the people you complement yourself with have to be good at that. But you're always going to be part of the equation. Even if you have a senior investment banker as your CFO who has done fundraising for all his life, the investor wants to see the founder. The investor wants to back the founder, believe in the founder. So it's part of what you do.
This leads me to two side questions with this. And when you say that the profiles are different in early and in growth, then would you be keen, or would you say, I would like to change sometimes the founding team in specific stories and specific companies because this team was very good for the early stage and now they need to step down and someone else needs to step up in the growth phase?
My comment was not so much that the profiles are different. It's the process of the VC is different.
Okay.
But to your question, there is plenty data that shows that the biggest outcomes have always been the ones that were founder driven. So the best outcomes are those where the founder can grow into stages and keeps being the founder CEO even at later stages. Whether it's Nvidia, whether it's Tesla, whether it's Microsoft back in the days, et cetera, et cetera. However, there are cases where that doesn't work. There are cases where a founder gets to his or her limits, where a founder was great in managing 30, 50 people, but just he or she admits himself that at 500 people, 1,000 people, I'm out of breath. And this is not what I'm good at. I'm not good at being a manager of 1,000 people because the job obviously changes a lot.
Totally.
And those cases, the healthiest ones are the ones where the founder himself says, we need to phase me out. I move to the board. I move to another role. I keep working 24/7 for the company, but in a slightly different role. And then we add a professional CEO and that manages the company. Case in point, Google back in the days, Eric Schmidt. So sometimes it's the founders that started. Sometimes The VCs might start that conversation, but generally works if the founder is fully on board with that proposition.
Yeah, yeah.
They are the ugly cases, but they are generally not the biggest success stories where there are board disagreements, founders being fired,
Yeah.
etc. Like that.
Different story.
Mostly it's because the company is doing very badly. It's not because it's a great story and there is only an issue in management. There are generally other issues behind it.
Yeah. Yeah. And also a question that came up to my mind when you were answering this first question about the founders is you said that you like people who's obsessed with the product. And the question to me is it possible to be obsessed with the product if you're not technical enough, especially in certain cases?
Yeah, by all means, because to me, product is not how you develop the product per se. The product is what should the purpose of the product do? How should it differ from what's in the market? And what do I want the ultimate experience to be? So even if you're zero technical, you can put yourself in the shoes of the customer and say, I want the solution to allow the customer to do X, and then go on the developers and CPOs' nerves until your vision is really, really, really put into form. If you just say, I want whatever payments to be faster, but you don't drill down in what that means, you are going to end up with a product that is incrementally better, but not transformative. Because the people that then put it into motion, into execution, well, they're paid employees. They say, okay, if my job is to make payments a fraction of a second faster, that's what I'm focused on. I'll probably take existing technologies, I tweak a bit the code, etc. And then it doesn't become transformational. And if the founder is too far away from how that end product should look like, yeah, you end up in complacency. You end up in sort of subpar results, if you ask me.
Got it. Let's jump into the next one. Okay. I don't know. The question is, what should you do with a company that is stuck around 1 million ARR for the last 4 or 5 years? So basically, I guess this is portfolio management.
Right. Yeah, I mean, there are plenty of those as well. So the first question is, I mean, is that directed to me as a VC or to the founder? And I think it makes a difference if that company is angel funded, bootstrapped, or VC funded, I think. If you're bootstrapped, you have to make a decision yourself as a founder or founding team. You can say, listen up, we can scale it to the minimum. We can have it super lean. It can throw out a couple $100K in profits a year. We'll just run it as a lifestyle business. As long as it goes, we run it. Every year we take out the cash. If we get to the point where the company cannot sustain itself anymore and not make profits, we shut it down. Perfectly okay decision to be made. If you are if you have some funding, but probably not at the top end of VC funding, then you might also decide to say, you know what, in agreement with our investors, let's bet the house. This is not working. Let's go for big or zero outcomes. Let's completely pivot to something that we think might work, put all the resources we have towards that, well knowing that probably we won't get any more funding for it. If it works out, great. If it doesn't, it goes to zero for everyone. Also a discussion that can be had. If you have been VC funded, are already in year 4 or 5 and have gotten some funding, as in 4 or 5 being stuck there, have gotten some funding, probably you already went through that exercise. Because from a VC perspective, probably people would have already pushed you in year 2 to say, okay, we are stuck for the second year. This is not working. The VC model is to go big.
home.
So let's try new things, and here's some more funding to try those new things. So if those haven't worked, then from a VC perspective, it wasn't the outcome, and it's part of the game. So and if you're at that size, probably you're not overly relevant for a sale either. It depends on the business you're in, but probably you're too small to sell. So really you have to sit down with your VC and say, you have to decide yourself, is it something that I want to run as a lifestyle business? And if it is, most larger VCs will accept to just give you their shares back in some form and say, all right, let's write it off. We get a small warrant. If it becomes $1 billion opportunity, we get our money back. But otherwise, we sell you our shares for €1. It didn't work out. Let's make a clean cut, because for a VC also, there is an admin associated with every investment. If you write something off, there is a tax benefit to be had. So sometimes it's better to just make a clean cut. And the alternative is, no, I don't want to run it as a founder, as a lifestyle business. Then you try to sell it at whatever price. And you agree with the VC and you say, listen, if it's $1 million ARR, it might be worth something to someone. It's not an acqui-hire, because we as a founding team don't want to keep doing what we're doing. So whatever the price, we'll just put it into someone else. And maybe the price is $50K, maybe it's $100K, maybe it's $500,000. But at that point, the decision is made to just, let's wrap it up without shutting it down.
Yeah. I like the wideness of the answer. Yeah, it's perfect.